The S&P is pretty much red right across the board today, and this is due to the consumer index data being released, where in fact we get to see price rises by 0.5%, and this takes the annual rate to around 3%. And ultimately what this means is that the market now expects the Fed not to have any rate cuts, and whilst we do get to see the next rate cut probability of around September, there are many analysts as well as big banks now believing that in the US a rate cut isn't going to be coming until December. And as we can see here, we are noticing a bit of an uptick, and this is now the fourth consecutive quarter where the data has been on the rise. Now today we really want to focus on 4 growth stocks, and we're also going to discuss one bonus pick. We'll talk about why it's a bonus pick as well towards the end of the episode. And as you can tell by now, the first one is Elf Beauty, which is a cosmetics company that offers affordable, cruelty-free makeup and skincare products, and they sell items through their website, major retailers, beauty stores, and pretty much they're known for high quality products targeting budget conscious consumers. Now if we take a look at the company, and if you have seen our dedicated deep dive, you will notice they are down significantly due to their earnings. This company over the last 12 months is down 57%. Been a shareholder over the last 5 years. Even given that drop, you would have massively outperformed the S&P, up 288%, and right now it is trading towards the lower end of the 52-week range. In fact, after their earnings, this company was trading in the $63 region. In fact, we have noticed it has recovered slightly by around $10. Having said all that, only Wall Street believe this company to be a buy right now, and if we were to see their earnings in a bit of detail, we can see they missed that latest quarter, although they did outperform on the previous 3, giving them a 75% track record, with 3 of the next 4 quarters anticipated to be growth. And if we look right now towards March 2026, based on the EPS data, this company now trades at a forward P of around 21. How does that compare against others in the sector? Well, in fact, it still trades at a premium. We are talking around 40%, but one thing to point out, their 5-year average has been significantly higher, now trading 46% lower. And the one constant theme when looking at their metrics is that right across the board, this company trades at a significant premium, but in relation to their 5-year average, this company is trading at a more attractive rate. If we were to look at the growth, which is important for a company trading at a premium, we want to see it above the sector comparison, and that is exactly what we get year on year, 46%, over the next 12 months, 36%, a lot better than the low single digit of the comparative from the sector, but also a lot better than their own 5-year average. So let me put it this way, we have Elf Beauty that is not only trading at a severe discount to their previous 5 years, but they're actually also showing growth that is a lot better, so it could look like a great opportunity to consider in the portfolio. If we do look at their earnings per share, expected to grow 14% over the next 3 to 5 years, a lot better than the sector at around 8%. However, this is one area they do lack in comparison to their own historical point of 23.2%. Now we also want to run through the profitability. They get a C. However, we do love the fact their margins are very high, 71% gross, above the sector at 36%, above their 5-year of 67%, and their bottom line equally as impressive, near the 8% mark, a lot healthier than the sector at 4%, but pretty much in line with their 5-year. And the cash this company does generate from operations, we get a D+, reason being over the last 12 months, it's only 35 million, which is not only significantly lower than the sector of 800 million, but also quite some way away their own 5-year data of 50.3 million. Now the final thing before we get into our own valuation is looking at the institutional aspect, where they own around 93%. They've been selling around $1 billion in pretty much 2024. However, they bought 3 times as much at $3.2 billion, and one constant theme, at least over the last 3 quarters, is that institutions were very bullish on Elf Beauty. Remember though, always do your own due diligence before buying any companies, and it will be interesting given their earnings in Q1 whether or not the institutions continue to load up. Jumping into the valuation for Elf Beauty, where we get $82, we'll show you because it is derived from purely the DCF model. We have the free cash flow year on year with the expectation of 120 in 2025. 3 different growth rates, but as always, numbers are subjective. You can grab a copy of this model by clicking on the pinned comment below, running through your own numbers, whether it's for Elf Beauty or any others. But based on 15% and the discount rate, we get the present value of future free cash flows and terminal value, add together with the cash, subtract total debt, get to the equity value, divide by shares outstanding, and $82 indicating 11% upside. Now, full transparency, for those that believe that is way too high, at 10%, intrinsically near the $60 mark, that is downside of 20%, and for those that are a lot more optimistic, given the growth we have seen, at 20%, $113, indicating 52% upside. Now, we do want to be more conservative today, therefore going for the 15% rate, but you could also argue, given the growth of this company, that 20% is reasonable. So at 15%, we always add a margin of safety, 10%, execute on that if it meets our 3 golden criteria: wide moat, strong financial metrics, good forward-looking data. If you believe that, then right now it is a buy at the $74 mark. Wall Street themselves are very bullish. $97 is where they see this by the end of 2025. That indicates 31% upside from this point, and actually a lot better than what the analysts believe the S&P will get in the same point of around 9 to 10%. We can also run through very briefly, for those that believe 20% to be more appropriate, the margin of safety. And if we look at 10%, a buy at 101, at 20% around $90, at 30% pretty much around the $79 mark. But right now, if you do believe they can grow at 20% for the foreseeable future, you're looking at a 35% MOS with, as we said, Wall Street 31% upside over the next year. And as always, give us your thoughts below. Now, before we jump into the next one, just to let you know, we have released our latest free weekly article. We drop one every single Monday morning, completely free into your inbox, where we cover severely undervalued stocks as well as what's gone in the market over the last few days. So click below, you can sign up, also grabbing access to 45 undervalued stocks for the month of February. Lots of information for each one, the upside that Wall Street themselves see over the next year, and you can also grab another spreadsheet of 43 stocks that Wall Street see as the most upside in the S&P right now. So click below, you can sign up, read straight away, and we'll also be updating this over the next few days. The next stock we're looking at is Lyft, which is a ride-sharing company connecting passengers with drivers through their mobile app. It also offers various transportation options, including standard rides, shared rides, luxury services, and the company also provides bike and scooter rentals in selective cities. If we were to look at the company, we do notice they are down around 7% today. Over the last 12 months, up around 8%. And if you've been a shareholder over the last 5 years, well, you would be down around 72%. We can see in that period, this company was around the $70 mark. Right now, though, trading towards the mid to low end of the 52-week range, and a double buy rating from both Seeking Alpha as well as Wall Street. And if we look at their earnings, always great to see a company that's outperformed, 100% track record. However, bear in mind, over the next 4 quarters, they are expecting 3 of them to be a decrease to the earnings per share, with the forward P right now, based on the December 25 figures, at 14.3. Comparatively, though, that does sit a lot lower than the sector at 20. That is a 35% discount, but also significantly lower than their own 5-year average. We're talking 63%, and that is a common theme when you do look across the vast majority of different valuations. In terms of the growth, well, now whilst they do get a D-, we can see year on year 25%, forward looking 20%, a lot better than the sector comparative at the low to mid single digit, and also better than their own 5-year average. If we do get to their 3 to 5 year earnings per share, well, we can see based on this a decrease of 11%, hence the F rating and the D- on growth. And as we do note here, the sector comparative comes in at 12%, definitely something we need to consider and also factor in when we get to our margin of safety. Profitability, they get a B-. Now, gross margin, 34%, just slightly higher than the sector, pretty much in line with their 5-year comparative. Bottom line, not looking good at -1%. What we would say, though, given the sector sits at 6.6 and their 5-year average is a lot worse, it does look like they are starting to improve over the long term, and hopefully it won't be too long before we do see this turn into a positive. And it's good to see their cash from operations over the last 12 months have been positive, $740 million, pretty much double or more than the sector comparative, and a lot better than the negative we've seen over the last 5 years. What have the institutions done? Well, ownership 83%, around $477 million worth of sales, a little bit more buys, but also good to see at least over the last 2 quarters, they were buying a significant amount more than they were selling. So what about the valuation of Lyft? Now we get to $27. Again, we'll show you how a similar format, we use the DCF model, but in terms of the growth rates, we do have -2%, 0 and 2, and we have tried to be on the more conservative side at -2, and this ultimately does come out to just over $27. Now bear in mind, earnings per share is expected to decrease based on the information we did just run through, but it does look, even with a very large margin of safety, this could definitely be one to consider, especially if you do believe over the longer term this company can produce the results. And let us know if you want us to take a deeper look at their earnings and understand where their shortcomings are. But 50% MOS is what we see, and remember that is based on a decrease to their free cash flow over the longer term. Wall Street themselves, they see a lot of upside, 34%, $18 price target, and this is definitely an interesting one. So as always, do give us your thoughts. We then move on to AstraZeneca, the pharma company that develops and manufactures prescription medicines focusing on treatments for oncology, cardiovascular, respiratory and rare diseases, and the company operates globally, conducting research in clinical trials to advance medical innovation. In terms of the company itself, well, up 20% over the last year. Over the last 10 years, up 115%, although it is lagging the S&P. Right now, trading pretty much in the mid to lower of the 52-week range, with every single analyst seeking alpha, Wall Street and Quant giving this a buy rating, and it does offer a yield of 2.13%. In terms of their earnings, love to see green pretty much right across the board, outperformed analyst targets, growth anticipated over the next 4 years, with their current forward P sitting at the 16.2 mark, which as we can see is lower than the sector comparative by 16% and around 10% lower than their own 5-year. And again, we do notice different valuation metrics, some of them showing at a premium, some of them at a discount, but overall it does look very healthy when we do look at the forward P. Growth looks to be good at a B+, 18% year on year, above the sector, above their 5-year. Moving forwards, next 12 months, 10% above the sector, although lower than their 5-year average. And we do quite like the fact that the EPS over the next 3 to 5, 13% above the comparative at 11, because remember, this company trades at a discount to the sector, but is looking to grow actually larger. But we do have to point out, over the last 5 years, they have, although only slightly, grown faster. In terms of the profitability, A+, love to see this. Gross margin, very high, 82%, above sector at 58, slightly above their 5-year of 81. Bottom line, 13%, a lot better. We see the sector losing money, -4%, and also better than their 5-year of 8.7. And we can see a lot of cash generated from operations, 12 billion. As we've already mentioned, sector is losing money, burning through -15 million over the last 12 months, but also better than their 5-year of 7.63 billion. If we look at the institutions, 20% ownership, we do see selling, but again, similar to the previous companies, more buying, and we also notice that theme pretty much more than double in the latest quarter. But as always, it will be interesting to see Q1 of 2025. Now, AstraZeneca, we get an intrinsic value of $87. You can see the free cash flows, the growth rates we have used, low, medium, and high, 8, 10, and 12, 3% on the low, 19 on the medium, and 40 on the high. But as always, we have taken the median rate today, 10% moving forwards, where we do apply a margin of safety at 10%, a buy $78 at 15%, pretty much where it sits now. Wall Street, very bullish, as we mentioned, triple buy rating across the board, $92 price target, 26% upside, and for those that just want to see at a 20% margin of safety, a buy at $70, at 25% 65, and at 30 around 61, but today's episode 15%. We then move on to Cake, which operates a chain of full service restaurants known for their large menus, generous portions, and extensive selection of cheesecakes. The company also owns and operates other restaurant brands and licenses its bakery products to third-party businesses. If we look at the company, it is up 44% over the last year, now trading around the $50 mark, down 2 to 3% on the day. Over the last 5 years, up 27%. Over the last 10 years, though, up only around 3%. But as always, will depend at which point you bought. The COVID drop, it was trading around the $16 mark. This does currently trade in the mid to upper end of the 52-week range, similar to the previous company, a triple buy rating, and also offers a dividend just above 2%. In terms of their earnings, green across the board, love to see that. In fact, the next 2 quarters, double-digit growth, and right now the forward P does sit at 14.03. How does that compare to the sector median? Well, another one that trades not only at a discount to the sector itself, but also at a very small discount to their own 5-year. But as we can see, it all really does come down to the valuation metric you want to use. Then we look at their growth, where they get a B. Now, year on year, not great at 2.4%, but in all honesty, that is in line with the sector, but a lot lower than their 5-year average of 9.4. In terms of moving forwards, 4.5%, a little bit better than the sector, but still underwhelming in comparison to their 10% from the last 5 years. In terms of the earnings per share, 11.3%, marginally above the sector, and pretty much in line with their historical data. In terms of profitability, we get a C+, gross margin 42%, slightly above the sector, pretty much in line with their 5-year average. Bottom line 3.6%, a little bit lower than the sector, but a lot better than their 5-year, which is pretty much flat. And cash from operations 242 million, not far off the sector, but a lot better than the last 5 years that we've seen from the Cheesecake Factory. Institutional ownership 95%, around 92 million worth of sales over the last year. We've seen pretty much double that in terms of the buys, and also quite a significant amount of buying in quarter 4. Institutions clearly do love this company. In terms of the valuation, we get to $56. Now when we take a look at the MOS, in fact 10% is where we see this company right now. For a lot of people that might not be sufficient, but we had to highlight it given the fact that Wall Street are incredibly bullish on this company. They see $65 over the next year, translating to 30% upside. If we were to look at a 15% MOS, a buy at $48, at 20% around $45, at 25 around $42. As we said though, 10% MOS, do give us your thoughts below. We then move on to the bonus pick, which is HIMSS, the Hims & Hers Health Incorporation. Now it's a telehealth company that provides prescriptions and over-the-counter health and wellness products, and they focus on treatments for hair loss, skincare, mental health, as well as sexual health through their online platform. Now, if we take a look at this company, currently trading at the $44 mark, it wasn't too long ago that we talked about this company being a strong buy around the $27, and the reason we're including this today, whilst it may not look incredibly attractive, we are yet to wait for their full year accounts, and therefore this could be one that has a lot more upside, but we want to get ahead just before the earnings. Now, in terms of over the last 12 months, it is up 348%. Over the last 5 years, again, similar, very strong performance, outperforming the S&P. Right now, trading towards the upper end of the 52-week range. In fact, very near a new all-time high. And Seeking Alpha give this company a buy rating. In terms of their earnings, well, look, over the next few quarters, they are expecting some tremendous growth, and great to see they've massively outperformed over the last 4 quarters. Right now, though, based on the forward P, they are trading around 84, which does look very, very high. No surprise then that it is significantly above the sector. In fact, you are paying right now a 247% premium, but again, you would be able to see that very conclusive no matter which metric you take a look at. Growth, on the other hand, as we would expect for a company trading at this rich valuation, does get a year-on-year and forward-looking in the 57 to 58% region, a lot better than the sector comparative, but one thing we have noted, at least on a historical basis, they have been increasing the top line at a slightly higher rate. In terms of looking at their free cash flow growth as well as their operating cash flow, a lot of very strong metrics here. We are talking triple digits, which as we can see, the sector itself doesn't come anywhere near. If we take a look at their profitability, where they get an A, margin as well looking very strong, not only above the sector, but we're seeing efficiencies. They're improving on the last 5 years on an average, and we can see 8% in terms of the bottom line. A lot better sector here as well, burning through cash, a lot better than their own last 5 years where they were also burning through cash. And if we get to the cash from operations, 187 million, a lot better than the negative of the sector, and a lot better than the very small amount in comparison of the last 5 years at 21 million. Institutions themselves, 64% ownership, 612 million worth of sales. So actually for the first time today, institutions, at least in 2024, were selling more than they were buying. However, we note the reversal in Q4 where institutions actually were buying more. If we look at our own valuation, now our intrinsic price is $39. However, the caveat of this is that we are waiting for the updated 2024 numbers. When we get that, we will have a better idea of where this company sits. But based on this information, when we did take a look at it last, we had a 20% growth rate where we got to $39. At that point, it was showing a lot of upside, a large margin of safety. But right now, you would need to expect 25% growth to get some upside of 16%. So based on the 20%, we can see $39. When we take it through to the final calculation, whilst there is no margin of safety today, for those that are interested at 10%, it would be a buy at $35. Wall Street themselves, though, at this point in time, do believe over the next year, the share price will lower to $35. They see downside of 22%. And as we said, we do like this company. It was looking very strong when it was trading in the mid-20 point. Now, though, we will have to wait to their earnings to get an updated understanding of where this company is going if they can continue to increase all of their metrics at the very rapid rate we have seen previously. As always, give us your thoughts about these growth stocks. Don't forget to sign up to the free weekly newsletter. Grab those spreadsheets. Also, come and join us in the Patreon where we do cover our weekly buys and sells. We have made some purchases and sales given the volatility over the last few weeks. weeks. And as always, have a great day. We'll see you all on the next one.